Okay, take a quick second and think about the credit card sitting in your pocket right now, or maybe that digital wallet you've got loaded up on your smartphone. Every single time you tap, swipe, or click buy, you are literally kicking off a massive chain reaction in the consumer finance industry. But have you ever actually stopped to wonder how investors and analysts evaluate the hidden non-financial risks behind those everyday transactions? Well, today we're unpacking exactly that in this explainer. So it really begs the question, what is the true cost of a credit card swipe? I mean, beyond the obvious merchant fees or the interest rates that jump to mind, there is a highly complex web of data management, security protocols, and internal sales mechanics operating 24/7 behind the scenes. We're going to look through the lens of standardized sustainability metrics to reveal those unseen mechanisms and the very real risks driving the consumer finance sector. Here is our roadmap for today. We'll define the SICS financial sector, explore the credit card engine, and then break down three massive areas of exposure: customer privacy, data security, and selling practices. Finally, we'll see how all of this impacts long-term value. Okay, let's dive into this. Starting with part one, the SICS financial sector. Before we get into the wild world of your personal data, we really need to set the macro context. To make sure we're all speaking the same language, the International Sustainability Standards Board uses something called SICS, the Sustainable Industry Classification System. It's essentially this comprehensive framework that categorizes 77 distinct industry-specific sustainability standards. This system is absolutely crucial because it helps entities rapidly identify the exact guidance and risk factors most relevant to their specific business models. And within that broader financial sector, consumer finance really stands out as a distinctly powerful and complex industry. Moving on to part two, the credit card engine. When we look at how this specific sector actually operates and generates its revenue, there is a clear heavyweight champion. The primary driver is revolving credit card loans. This is the undisputed engine of the sector. Literally everything revolves around the credit card. Now, sure, secondary services like automobile loans, microlending, student loans, and consumer-to-consumer money transfers, those are undeniably important. But revolving credit? That is what truly powers the industry's profitability and massive scale. Now, what's really interesting about this slide is how we actually measure the sheer footprint of that credit card engine. Activity metrics quantify scale by tracking the number of unique consumers, as well as the absolute number of active credit card and prepaid debit card accounts. Investors use these metrics to normalize data and make direct comparisons between companies. We aren't just talking about millions of dollars here. We're talking about millions of unique human beings trusting these institutions with their daily lives and their highly personal data. Which brings us to part three, risk one, customer privacy. With millions of active accounts comes an unimaginable amount of personal data. What exactly happens to your demographic, behavioral, and location data once they have it? Well, the standard explicitly outlines a very important concept called a secondary purpose. This is when an entity intentionally uses your data outside the primary reason it was collected. So think of it like this. The primary purpose is just processing your transactions so you can buy your morning coffee. The secondary purpose is monetizing the data from that coffee run, like tracking your buying habits to sell targeted ads or sharing your location data with third-party affiliates. It's a critical distinction in the eyes of regulators and investors. Because of the inherent risks here, investors look really closely at these specific customer privacy metrics. They want to know the exact number of account holders whose information is used for those secondary purposes. They look at the total monetary losses from legal proceedings tied to privacy failures, and they heavily scrutinize the nature of explicit opt-in consent policies. If a company mishandles this, the fallout is severe. We're talking lost consumer confidence, high employee turnover, and massive legal risks from regulatory bodies. Let's look at part four, risk two, data security. It is one thing for a company to willingly monetize your data. It's another thing entirely for them to just lose it to hackers. Let's define the absolute nightmare scenario for any financial institution, a personal data breach. This is the accidental or unauthorized destruction, loss, alteration, or access to personal data that is stored or transmitted. This isn't just some minor IT glitch, right? A breach fundamentally jeopardizes the confidentiality, integrity, and availability of an entity's entire information system, leaving consumers totally exposed. To measure exactly how well a company is defending its perimeter, we rely on these core data security metrics. Companies have to disclose the raw number of data breaches and the exact number of affected accounts. Crucially, they also track financial fraud losses, and they split them between traditional card-present fraud and card-not-present fraud, which is the stuff that happens online or over the phone. And to stop emerging attack vectors, things like ransomware or complex money mule schemes, companies disclose how closely their security protocols actually align with rigorous external frameworks, like NIST or the ISO 2700 series. On to Part 5, Risk 3, Selling Practices. Now, let's turn our attention inward, away from external hackers and towards internal company culture. Right at the heart of selling practices is a compensation structure called variable remuneration. That's basically just a fancy way of saying pay that is not fixed. It's often directly linked to the amount of products and services an employee manages to sell to customers. And while hitting a bonus target sounds awesome for the employee, this compensation structure can severely misalign with a client's actual financial best interest, basically incentivizing staff to push products a customer simply doesn't need. And this brilliantly illustrates a dangerous domino effect inside a bank. It starts at step 1, with variable remuneration strictly linked to aggressive sales targets. This pressure predictably leads to step 2, employees aggressively selling add-on products, things like expensive debt protection or identity theft services. Ultimately, this all culminates in step 3, heavily increased customer complaints, intervention from financial ombudsmen, and some highly damaging legal proceedings. So how do analysts actually track this internal risk? Well, they use these precise selling practices metrics. They look at the percentage of variable remuneration for covered sales staff. They check the approval rates for credit products just to see if lending standards are, irresponsibly slipping. They monitor the average APR and the average fees squeezed from those add-on products. And of course, they track the sheer number of customer complaints filed. Together, these metrics really reveal whether a company is responsibly protecting its long-term value or just exploiting short-term revenue generation. Because if a company gets those selling practices wrong, the results is captured in this single devastating metric, the total amount of monetary losses. We are talking about massive fines, civil judgments, regulatory disgorgement, and restitution to consumers. Deceptive practices don't just harm the individual. They result in catastrophic financial liabilities that can completely wipe out an institution's profits and permanently damage its reputation. Finally, Part 6, Protecting Long-Term Value. Let's pivot and connect all of these seemingly non-financial metrics directly back to the ultimate bottom line of these massive corporations. The standards state this very clearly. SASB standards are intended to aid entities in disclosing information about sustainability-related risks and opportunities that could reasonably be expected to affect the entity's cash flows. So, the crucial point is this: managing customer privacy, thwarting cyber attacks, and ensuring ethical selling practices, these aren't just feel-good PR exercises. They are the absolute bedrock required to ensure long-term cash flows, maintain access to capital, and most importantly, secure the trust of the consumer. And that really brings us full circle. The very next time you pull out that piece of plastic or tap your phone to pay, remember the massive engine operating in the background. Think about the demographic data being collected, the cybersecurity perimeters being tested, and those hidden incentives driving the sales on your account. Based on the real-world metrics we've explored today, how does the bank in your wallet measure up? Thanks so much for joining me on this explainer, and remember to always look behind the numbers.